Welcome to our deep dive on retiring early through disciplined investing and extreme savings. Today, we will debunk myths about aggressive investing, clarify the difference between taking risk and speculating, and show how behavior, more than products, drives outcomes. To set the tone, we will start by reframing what actually accelerates early retirement. Then, we will move into practical steps and strategies to implement right away. Finally, we will test your knowledge with a couple of quick quizzes and wrap up with key takeaways. Here is today's agenda. First, we will reveal the brutal truth behind aggressive investing. Next, we will explain why a high savings rate is the true accelerator for early retirement. Then, we will distinguish aggressive allocations from outright speculation. After that, we will examine behavioral traps, such as fund switching and timing dips. Furthermore, we will look at calculated ways to add risk through global diversification and factor tilts. Then, we will cover the order of operations, focusing on maximizing tax-advantaged accounts. Finally, we will test your knowledge with short quizzes and conclude with actionable takeaways. Before we jump in, let's acknowledge a common pattern. Many investors hope there is a perfect fund or timing method that dramatically shortens the path to early retirement. However, the reality is that process, not product, delivers results. A high savings rate, broad diversification, low costs, and discipline during volatile periods beat product selection and market timing over the long term. With that in mind, let's move forward to the brutal truth. Here's the brutal truth. The primary accelerator for early retirement is not a special ETF or a clever trade. It's an extreme savings rate, often 60% or more. A portfolio that is 100% in stocks is already a highly aggressive allocation, even if it is invested in a broad market index fund. If that doesn't feel risky enough, what you're seeking is speculation rather than prudent risk. Moreover, the most aggressive behavior is actually staying the course through volatility. Choosing a strategy and holding onto it for years is difficult, yet it is the exact behavior that compounds returns. Conversely, trying to time market dips and jumping between funds such as VOO and FTech frequently leads to selling winners prematurely or buying at high prices. As we proceed, let's contrast true aggressiveness with speculation. This mind map visually distinguishes aggressive investing from speculative behavior. On the aggressive side, we see elements like a 100% broad stock index allocation, global diversification, low fees, long holding periods, and periodic rebalancing. On the speculative side, we have frequent switching, timing dips, narrow or concentrated bets, leverage or options, and performance chasing. The central theme is investor behavior. Discipline is the gatekeeper that determines whether risk leads to compounding or to costly mistakes. Next, we will dive deeper into how to take smart risk without sliding into speculation. Aggressive investing does not mean speculative trading. A 100% stock allocation in a broad index fund is already aggressive. If you want additional calculated risk, you can expand beyond U.S. large caps to a total world index. Or you can consider factor tilts such as small cap, value, quality, or momentum. However, these introduce added volatility and the potential for long stretches of underperformance versus a standard benchmark. Speculation, by contrast, involves concentrated bets, market timing, leverage, or chasing themes. If your portfolio feels a bit boring, that is often a good sign, because compounding works best when it is uninterrupted. Next, let's examine the behavioral pitfalls that derail compounding. On the left, we have disciplined actions: writing down a plan, rebalancing periodically, ignoring short-term noise, holding broad index funds, and automating contributions. These behaviors support compounding. On the right, we see behaviors that undermine results: frequent switching between ETFs, timing dips, selling winners early, chasing hot sectors, and reacting to headlines. The difference is not subtle. Disciplined consistency enables outcomes, while reactive switching erodes them. Next, we will look at a common behavioral trap and how to avoid it. Common traps include switching between broad market funds and sector funds like VOO and FTech based on headlines or recent performance. This behavior often results in buying high and selling low. Investors can become overconfident after a short-term win and fearful after a loss, leading to inconsistent actions. Another trap is confusing activity with progress. Being busy is not a strategy. Instead, remain consistent with your plan, automate contributions, and let compounding do the heavy lifting. Now, let's organize your investing steps with a clear order of operations. Follow this order of operations. First, build a 3 to 6 month emergency fund to avoid forced selling. Next, capture your full employer match because it is a guaranteed return. Then, maximize tax-advantaged accounts such as a Roth IRA or HSA if you are eligible. After that, increase contributions to your workplace plan toward your target savings rate. For core holdings, choose low-cost broad market funds, either a U.S. total market or a total world index. Optionally, add factor tilts, but be aware they introduce volatility and tracking error. Finally, rebalance annually and avoid performance chasing. Next, we will summarize account priorities in a simple table. This table summarizes account priorities. First, contribute to your employer plan to capture the full match. Second, fund a Roth IRA if eligible for tax-free growth. Third, use a health savings account if eligible because of its triple tax advantage. Fourth, increase contributions to your workplace plan beyond the match to move toward your target savings rate. Fifth, use a taxable brokerage account for additional investing and to bridge years before retirement accounts become accessible. Next, we will visualize where returns actually come from. This pie chart emphasizes that your savings rate contributes the largest share to achieving early retirement, followed by asset allocation. Behavior and discipline also play a meaningful role by ensuring you stick to the plan, while fees and costs should be kept low to avoid drag. The exact percentages are illustrative, but the hierarchy is robust. Savings rate dominates, allocation matters, and behavior is the glue. Now, let's discuss adding risk the smart way with global diversification and factor tilts. To add calculated risk beyond U.S. large caps, consider a total world index to reduce home country bias. If you seek additional return drivers, factor tilts such as small cap, value, quality, or momentum can be layered carefully. However, these come with higher volatility and the potential for long periods of underperformance relative to standard benchmarks. For this reason, any tilts should be sized modestly and committed to in advance. Above all, keep costs low and avoid complexity that introduces hidden fees or behavioral temptations. Now, let's test your understanding with a quick quiz. Question: what is the most reliable accelerator for early retirement? Option A, a single magic ETF. Option B, an extreme savings rate, for example 60% or more. Option C, switching funds during market dips. Option D, timing the market perfectly. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, an extreme savings rate such as 60% or higher. This is the lever you fully control, and it accelerates your path to financial independence. Next, let's take another short quiz to reinforce the difference between aggressiveness and speculation. Question: a 100% U.S. broad stock index allocation is best described as which of the following? A, conservative, B, moderate, C, aggressive, or D, speculative. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, aggressive. A 100% stock allocation is already a high-risk, high-volatility approach, even if diversified through a broad index. Now, let's consolidate the most important ideas into concise key points. Here are the key takeaways. First, an extreme savings rate outperforms the search for magic products. Second, a 100% stock index allocation is already aggressive, and going further often turns into speculation. Third, discipline beats timing. Avoid hopping between funds. Fourth, if you add risk through global diversification or factor tilts, do it cautiously and commit for the long term. Fifth, maximize tax-advantaged accounts before experimenting with complexity. Finally, write a plan, automate contributions, rebalance periodically, and stay the course. Next, we'll summarize with a simple action-oriented recap. This recap ties it all together. Start by targeting a high savings rate and automate it. Capture your employer match and maximize tax-advantaged accounts. Hold broad, low-cost index funds to keep fees low. If you add risk, use global exposure or modest factor tilts only if you can maintain discipline over long stretches. Ultimately, success comes from not quitting during volatile years. Before we close, let's review an important disclaimer. Disclaimer: This video is for educational purposes only and does not constitute financial, investment, or tax advice. Your situation is unique, and you should do your own research and consider consulting a qualified professional before making any financial decisions. With that clarified, let's wrap up. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs a reality check on aggressive investing, and subscribe for more evidence-based content. I would love to hear your savings rate goal and the single step you will take this week. Share your thoughts in the comments. See you in the next one.